Good morning, everybody. It is September 20th, 2019. And the big news this week was the attack on the Saudi oil refinery and production center. Um, this is something that I've talked about was probably coming, more conflict in the Middle East for about 2.5 years now. And I don't think any of this was unforeseeable. The problem has been trying to trade it. So let's talk today about what's going on in the Middle East, where the information is coming from, what's probably right, what's probably wrong, what's probably next. So first off, this is Stratfor. This is something that I subscribe to and I use quite a bit. And they point out that Iran is essentially calling Donald Trump's bluff. And earlier, I had said that Iran probably wants Donald Trump to not be president. So what could they do to put pressure on him? They know that if he deploys troops to the Middle East, that's bad for him. They also know that if they hurt the economy, that's bad for him. And they also know that raising the price of oil is something that could hurt the economy, bad for him. So what does the United States and President Trump do in response? So far, they've put further sanctions on the National Bank of Iran. So they're trying to strangle them financially. The thing is, Iran has quite a bit of accumulated wealth that they can tap, at least in the short run. So Stratfor points out that the big picture here is that the United States is trying to find a balance of power in the Middle East. Survival strategy for Saudi Arabia and the royal family there, then Iran's arc of influence. Years ago, back in the early 1990s, I worked for a professor, essentially. Was the guy going to the library picking up books and pouring some coffee. But they wrote a paper, the professor and his graduate team, and many people here were in the United States writing similar papers about the eventual outcomes in the Middle East as we eventually enter the end of the oil age. The end of the oil age is something that is not hypothetical. It's going to happen. And smarter minds than mine have been postulating since the 1970s that it would eventually happen because of new technologies that would make oil much less relevant. As we have seen recently, that is starting to become true as oil demand, not just for short-term economic reasons, but for long-term secular reasons, is no longer growing very fast. And in fact, we are probably right at the very beginning of what I have called the peak oil plateau. The peak oil plateau is different than just peak oil. The plateau is that point where supply and demand will be roughly balanced and neither decreasing nor increasing very much for an extended period of time, at least several years, potentially as long as a decade. We are unlikely to see oil demand go up much more than 1 million or 2 million or 3 million barrels from current levels. So the idea that oil demand will keep increasing through 2040, anybody who still believes that, believes it, and this is different than saying it, but actually believes it, just doesn't understand math. And it's really that simple. The actual demand for oil is no longer really going up for any appreciable reason other than short-term cyclicality, as the automobile industry has really hit their own plateau for demand as we enter an age of ride sharing and more people living in cities. So the distances driven are shortening up, and mileage is going up and up and up. And there's about to be another huge increase in mileage on cars as hybrids, as Toyota is proving, are they can produce them basically for $1,000 extra, maybe $1,500 extra dollars compared to an ICE vehicle. My son just bought a Toyota Corolla. He's getting around 60 miles to the gallon driving around in the city. If the price of oil goes up, he's really going to appreciate that. But the bottom line is that the Corolla on the highway would normally get 35, 40 miles to the gallon. He is getting 60 in the city and about 55 on the highway. So hybrids are a topic that I talked about years and years ago. You could probably Google the article, The Hybrid Future of Cars, put my last name. It'll pop up on MarketWatch. During this peak oil plateau, with slightly increasing demand for cars from the Middle East, in the middle class, but with mileage going up more than the increase in demand for cars, that really spells a formula for oil demand to flatten out dramatically and probably start to turn over within a decade. People point out petrochemicals. The problem with petrochemicals is that there's a replacement for those already too. Technology has created, and there's a company that I've referenced before, New Light Technology out in California, and others are going to have something similar, where you can make plastics by taking methane and carbon dioxide, and basically you can turn it into plastic. You no longer need the feedstock of the petrochemicals. So, there's quite a bit coming technologically that is going to prevent demand for oil really from ever going up dramatically ever again. It's just at this point a matter of, okay, when do we retire enough gasoline cars? And when do enough plastics manufacturers change to different processes to cut the demand for oil? And I talked about that in an article, a couple of articles, but here's the chart. This period here that we're entering, which I'm calling the peak oil plateau, eventually is going to hit a point, and I think it'll be the 2030s, where the demand for oil falls off a cliff. And understand what these numbers are here. So it's not going from 103-4 million barrels a day down to zero, but it's going to go down to probably around 50 million barrels a day by the middle of the century. And then it'll level off, and we'll probably use some oil for emergencies, for legacy vehicles. There'll be random things that we use it for through the end of the century. But that curve will just keep going down to the point where we're probably using 10 million barrels a day at some point. And that'll be specialty, it'll be legacy, and there just won't be much of it. So during the 2020s, in the very short term, because of the decline in offshore oil, we should see demand stay slightly above supply. And what happened in the Middle East could spur that, because between that and the Permian, there isn't very much extra oil supply left in the world that we can get at easily. So the spare capacity is really in Saudi Arabia and the Permian oil basin. What we know is that all the other shale basins in the United States are slowing down in their production. Why? High grading. We talked about that before. The high grading means that the oil companies went for the easiest oil first, and now they're getting to the harder oil. In Colorado, in Oklahoma, where there's earthquakes, in the Bakken, it is more difficult to get oil at low prices. So while they can still get oil, it becomes incrementally more expensive. In Colorado, you have legal challenges now to where the wells go. In Oklahoma, you have limits because of the earthquakes. And the Bakken is really just starting to run out of oil finally. So when we go back and we think about what does this really mean with Iran and Saudi Arabia, it can only mean one thing. It can mean that there's going to be more pressure on the price of oil. Now, the price of oil and whether or not stocks of the oil companies go up are different things. So even if we get to $80 oil, which I think is likely next summer, but I thought it was likely this summer, a year ago. So we'll see. I could tell you what's going to happen. I just can't necessarily tell you when. And that's been a problem with oil. It's really the only market that I've ever been stumped on for a prolonged period. Made a lot of money in oil for 20 years. And in the last 4, man, if you weren't a good trader, you had some trouble with it. Remember in our chat, one of the chats over at Margin of Safety Investing, I mentioned that I saw a report that cruise missiles have been used to strike Saudi Arabia. And a couple of people were doubtful that that had happened. Now, if you're not using Twitter for news and independent coverage of things, you're missing out. There are some very good people around the world, hundreds of them, thousands of them, who do some very good reporting. This guy, somebody forwarded this, so now I follow him. This guy's a historian. He follows the news. He's a good analyst. I've gone through his feed. This is the guy who said first that cruise missiles were used on the Saudi Arabian facility. And he couldn't get published because the United States was saying, no, it was just drones, and Saudi Arabia was saying it's drones. As we know now, there were multiple cruise missiles used to strike the facility in Saudi Arabia. So if you're not following this guy and people like him, I would take a look at following people like this. I don't know entirely who he is. I've done a little back checking. He's done some writing for the Globe Post. But his Twitter feed is full of a lot of interesting news. And we're going to go through some of these things throughout today's webinar. So what do we know so far? We know that the attacks did not come from Yemen. We know that the attacks came from over here somewhere, in complete opposite direction. There were multiple cruise missiles and drones, and that has put a crimp in Saudi oil production to the tune of over 5 million barrels a day, which is about 5% of global supply. There's been other attacks on Saudi facilities, all coming from Iran. And remember what I told you, in the early 1990s, I worked on this paper, and the ultimate resolution to the conflict in the Middle East between the Shia and the Shiites, between the Saudi royal family and the Ayatollah in Iran, has always been the idea that they would either have to work out their differences or they would come to conflict. President George W. Bush, for all the things that he did wrong, one of the things he did that could be wrong, could be right, but was in line with the thinking of the analysts and the Pentagon at the time, was eventually you wanted to get rid of Iraq as the wall between Iran and Saudi Arabia. Saudi Arabia has always been terrified that Iran would come over the Arabian Peninsula and try to take them over or attack them. When we installed Saddam, it was to protect our oil supply, which at the time we needed. And then after 9/11, which was carried out by Saudi terrorists, most probably, and all the evidence points to, supported by Iran, right? So Iran supporting Saudi terrorists who were unhappy with the royal family, and by extension, the United States. So Saudi Arabia attacked us with the backing of Iran. That's essentially what happened during 9/11. So what did we do? We didn't get rid of Iraq because of the chemical weapons, which turns out were there. We also know at this point that those chemical weapons got shipped to Syria and have since been used. In any case, we got rid of the wall between Iran and Saudi Arabia because we deposed of Saddam Hussein. And now Iran has basically got troops all over Iraq and Syria. The IRGC is throughout the Middle East now. What is going to happen here? Do we believe that there will suddenly be peace? Do we believe they'll work out their differences? The Ayatollah just said he won't even negotiate with us while we have sanctions on Iran. And they attacked. What do we do next? I would be surprised if there isn't massive retaliation against Iran in the next several weeks. If that happens, the price of oil goes straight up. Probably goes over $100 a barrel, at least in the short term. Saudi Arabia is not going to get all of their production back online in the next month or two. What they're doing to meet orders is using all of their inventory. Here's the problem. At 5 million barrels a day, let's suppose the rest of the world comes up with 2 of that, which is optimistic. 3 million barrels a day not getting produced by Saudi Arabia for 3 months. You know, you're looking at an awful lot of inventory coming down. Inventory right now is in the middle of its 5-year range, but this 5-year range is higher than previous ranges because there's been more oil the last 5 years. What we really could see happen is the price of oil go back to where it was pre-2015. Why? Because inventories are going to come down to that level of pre-2015. So the new oil age, this little short bubble of excess oil, probably goes away. So all we really have to do is take a look at what the reality was before 2015, and that was $70, $80, $90 a barrel oil. Now, will it stay that high for long? Probably not. It'll probably gravitate towards the low end of that range, of that 80 to 100 range that I identified years ago, which I have since amended to $70 to $90 a barrel. And why would it go to the low end of the range? Because of what I pointed out a second ago with that peak oil. Demand isn't increasing that much, so we don't need supply to be that high. So there's going to be some balance here for several years, maybe for an entire decade, between supply and demand. Inventories in the short term are going to come down. Shale is going to produce another 1 million or 2 million barrels a day by next year or the year after, but that oil will be more expensive. So you have a lot of moving parts. The bottom line is that the price of oil will not be in the $50 to $60 range until demand actually starts to tip over. In the shorter term, over the next 5, 6, 7, 8, 9, 10 years, we should expect that $70 to $90 range to be the range. It could spike over 100 on an attack with Iran, but that oil is already out of the market. We know that Venezuela is having difficulty. We know Libya is having difficulty, but those issues come and go. Producing 100 million barrels a day is not really a problem, at least for the next decade, even as offshore falls off. Why? Because ultimately, Saudi Arabia, if they are secure, and that's the question, right? You know, there's going to be higher prices in oil because we don't know if Saudi Arabia is secure. However, if they are secure, they can easily pump 12 million barrels a day. They can probably get up to 15, 16, 17, 18, 19, maybe even 20 million barrels a day, as they've said, if they put the pedal to the metal. So we are not ever going to see a long-term shortage of oil in our lifetime. Why? Because there's plenty of supply now, even though inventories will come down in the short run and probably settle there, because there's not a lot of incentive to build up huge inventories, given that we know oil demand is flattening and probably within a decade will start to fall. So there's your forecast. How do you trade it? Well, let me support some of this. We'll go back to Babak. He has been covering some of the things that I've been talking about, and I read this from other sources. The fact that this guy is out there, I've been reading his string. It's pretty good. Um, you know, Pompeo backed what he said about the cruise missiles. Um, got it published, but there's more conflict brewing. Israel has been very active in Syria, and typically Russia allowed them to attack the Iranian forces, which is interesting because Russia is supposedly a uh, ally of Iran. So Israel would attack IRGC bases in Syria. Russia allowed it, but Israel wanted to target some Syrian things, and Russia blocked them with MiGs. So there's a lot of cat and mouse going on and a lot of bombs flying. A few weeks ago on this webinar, I said that Netanyahu could start a war in the Middle East to get the elections delayed. Apparently, he tried, and he was prevented from doing so. And now there's a split government in Israel. So don't discount that Netanyahu is, if nothing else, a survivor. He's going to try to survive this, even if it means going further to war. Over at Stratfor, they have the U.S. Naval update, and as you can see, more ships gravitating to the Middle East and towards China. So, we have to be aware that there are, and this is what we know, right? There's many more ships out there. So we have strike forces in the Middle East, more than normal, and in the Mediterranean as well. There's been reports that we've had, I believe, destroyers here in the Mediterranean. If you go to worldview.com, which I don't have up right now, you can see some of this stuff as well. Talked about the oil trade going to 100 at some point, way back 2.5 years ago. Is the calm before the storm ending? Probably. HFIR points out that oil well productivity is turning down. I've been talking about that for quite a long time, that it'd be coming. Now they're demonstrating that it is actually happening. It's really only the Permian where we're getting oil. Even offshore in the Gulf, because we've really gotten all the easy to get shelf oil, there's not really much left to be done in the shelf. So deep water is difficult to do. And if the Democrats win the election next year for presidency, you're going to see the price of oil even go up higher, because they already have said, every single one of them has said, no more drilling on public lands, no more new offshore leases. So is shale dying? No, it's just maturing. I subscribe to Oil and Gas 360. I read this stuff all the time. It's a very simple thesis. Again, the Permian is where the leaders are. Everybody else is already facing production problems. The Permian will continue to grow for a year or two, maybe 3, add another 1 million or 2 million barrels. It'll fill those pipelines, but the oil will gradually get more expensive, because the easy to get stuff, the high graded wells, the next set of wells has to be less effective. It's not as good pay dirt. What's going on in the oil patch? We're already seeing signs of huge financial stress on some of the smaller, more leveraged producers. Ultra Petroleum has got problems. They're not even going to drill anymore. EQT is laying off people. These guys are trying to refinance debt. All three of these companies could end up bankrupt. Ultra, EQT. WPX. So where do you go? It's the Permian stocks. Go to this article, the Permian Pure Plays, Concho, Diamondback, Parsley. Parsley, I'm going to show you a chart. It's very widely speculated they get bought, and I think that's right. Centennial, Pioneer, those 5 companies are the pure plays. That's a pretty good basket right there. Cool buy in the Permian, ConocoPhillips, Devon Energy's talking merger with somebody, hasn't come to happen. And Cana, I think, ends up getting sold piece by piece. Could be taken over. They could merge with Devon or Marathon Oil. EOG Resources, I don't see a lot of M&A activity for them, mainly because they have such cheap production right now. I don't know that they could improve their situation, so why would they do anything? I think it's more likely the EOG sells off some parts and really focuses down here and in the Bakken. But I could see EOG selling a lot of this, the Rocky Mountain stuff. So, somebody asked me about Occidental, and I'm going to close some of these in case that's contributing to the blurriness that comes and goes, apparently. The merger of Occidental and Anadarko, I know, is getting a lot of flack, even from Carl Icahn. Icahn doesn't like the funding from Buffett. And that seems to me to be the only problem with that Occidental Anadarko deal. Occidental probably could have had better financing options. However, they may not have had time because of the pressure from Chevron. So Chevron putting in the offer for Anadarko forced Occidental to go to Buffett because they needed the money right then. Right? They couldn't wait. But I like the Occidental deal. And when we take a look at money flow, we can see that Occidental, on the monthly basis, has been beat down horribly. This is what we look for, right? We look for a bottoming and then a slow recovery. This is the monthly chart. Let's go to the weekly. The weekly is just starting to inch back up. The daily is traders and doesn't matter that much to us. But look, it's beaten down here too. Occidental in these middle 40s, where the price has been building a really nice chart here. And that is a classic bottom right there. Now, could it dip one more time? It sure could. But I think we see Occidental run back up into the 50s in no time and probably back up here to this level in the 60s by summertime. I really think that this rally is ready. It's finally happening. Now, I thought it was happening here. I did. But we came down here. Why? Because people don't like the fact that some oil companies are acquiring. Well, if some oil companies aren't acquiring, who could sell? That's a good question, right? Everybody can't be a seller. So Occidental, what I believe, is that they're going to keep selling core assets or non-core assets. They just made $650 million. They've already got an $8 billion deal with Total for the African assets. And they're looking to sell $15 billion. They're already at $9 billion. They have another pipeline company they can sell. And I think that they can sell assets in Oklahoma and the Rocky Mountains. Really focus largely on Texas. So I'm a buyer of Occidental at these prices. Now, let's talk about asset allocation for a second before we get to the other oil companies. Do you go 20, 25% in oil? It's a risky bet, right? Why? Because any bet that exceeds the index value of that sector becomes incrementally more risky. So about 6% of the S&P 500 is energy stocks, mainly oil and gas. At 12%, you're double weighting energy. I think that's reasonable from these prices. Do you want to triple it or quadruple it like I tried? Understand that the risk is very large. What if technology moves faster? What if we don't attack Iran? What if we just protect Saudi Arabia? Those are things to consider. So look at valuations. The valuations of these stocks are very low. They should go up in price. But as I covered in the article, the reasons why oil stocks are priced for Armageddon, Google oil stock Armageddon Spano, it should pop up. Maybe there's just not an appetite for people to buy oil stocks ever, no matter how profitable they are. We've seen 2 companies go private already since I started talking about it a couple of months ago. I mentioned it in the comments section of somebody else's article that we're going to see oil companies go private. It's already happened. I can see Continental Resources going private if the price doesn't go up of the stock. Harold Hamm's already talked about it's kind of worthless to be a publicly traded oil company now. Well, what does that mean? Private equity companies are just going to put pen to paper and figure out, okay, what are the prices where it makes sense for us to buy an oil company outright, take it private, and then just skim all the profits. Those numbers are right about where we're at. So I would expect either the price of oil stocks to go up probably 20, 30, 40, 50% quickly, or we're going to see take privates relatively soon. Again, 2 have already happened. Encana, monthly chart, it based, it's drifting upwards. The weekly says it can go down in the short term. Go back to this low. But, at $5 a share, I just don't know how you don't buy Encana. Pioneer, that one bottomed out. I think Pioneer is a real good buy right here. Concho bottomed out. That's a real good buy right here. Devon Energy bottomed out and is starting to come back. Why? Because as I've talked about for the last couple of months, they're very likely to engage in some sort of mergers and acquisitions activity, probably merging with somebody. And what do we know about mergers? The market freaking hates them right now, at least with oil companies. So you might not, might get a pullback yet in Devon. Parsley has turned up dramatically. It's something that, we nibbled on. Why? Because everybody expects them just to get bought out. Chevron's rumored and Exxon's rumored to just going to write a check for these guys. So in the oil patch, you have to take a look at where the money flow is in the longer term and in the shorter term. So could Parsley have a little correction? A little correction. But, there's clearly acquisition going on by bigger money. That's what the money flows show you. So month to month, but week to week, you see it sell off. Day traders, you're in the middle of the market. Flip a coin. All right, let me take a look at a couple of more oil questions here. I think I've covered most of this. Oh, so China didn't invest a lot of money in Iran. It invested a lot of money in Iraq. And one of the things that I talked about, I already closed the article, but in that article on Market Watch from 2.5 years ago, I talked about China could be the new wall of Iraq in Iraq. So the wall between Iran and Saudi Arabia. I talked about what if Iraq sells a whole bunch of property, and does joint deals with China. Well, that's exactly what they just did. So China has a very vested interest in Iraq right now, which means you could see them drop 250,000 people in there quickly. They've done it in other countries. So there's a possibility that China becomes the Iraq wall. So the little wall of Iraq between Iran and Saudi Arabia. You could see China go and clean up that region. That's another reason why you don't want to put a huge bet on oil anymore, because one, the long-term trends are happening faster than we thought they would. The divestment movement is strong. And what if China decides to be the peacekeeper? They need the oil for a while. So we could see China being the peacekeeper in the Middle East for the next 10 years so they can get oil from everybody. It could happen. Yeah. Somebody pointed out that if we attack Iran, which I think is likely, there'd be another wave of refugees. And for sure there would be. However, the surgical nature of some of these attacks, I think, prevents a crisis. And remember, if the Iranians can hit specific towers of a oil facility, we can do the same thing. I believe that our technology, and reading Stratfor and other defense websites, is so good that we can essentially, remember the movie, there's a movie 30 years ago where they almost launched nuclear weapons, right? And they showed all the simulations on the screen. Maybe remembers what movie that was. It was some kid, might have been Matthew Broderick, I don't remember. But we have the ability from space to target thousands of targets and launch missiles almost was it war games? Yeah, simultaneously. We could, if we chose, wipe out most bases of the Iranian Republican Guard Corps and their navy and their nuclear facilities, and then a couple of select oil and gas facilities. I think that's the type of attack that's coming. I could be wrong. Maybe President Trump backs off. But an attack on that sort of thing, and then helping Saudi Arabia get their oil back online by next summer, and encouraging the people in the Permian to drill, baby, drill, that could bring the price of oil back down by summertime. And people aren't going to be motivated or not motivated to vote next November until about November. People don't decide whether or not they're going to vote in April. They decide whether or not they're going to vote the week of the election. All research has shown that. So you've got your 40% of Americans that vote all the time. And you got your 40% of the Americans that never vote. And the other 20%, they decide that week. Is my life good enough or bad enough to make, to spend 20 minutes going to the polls? Because that 20 minutes, man, I could miss a couple of good commercials. So, let's keep an eye on what's going on with oil. Don't get over your skis. Remember, you don't have to make your money back where you lost it. Druckenmiller told us, as I've been saying for quite a while, invest in the disruptors, not the grandpa stocks. Oil is so undervalued that you should have a position, but I don't know that any more than a double position is warranted. If you're more than about 12% oil, you should be looking to whittle it back, especially on rallies. That's my opinion. If you're very aggressive, you can get more in there. I wouldn't be using options. The stocks are cheap enough and they're starting to pay dividends. Just buy the stocks. All right. Short-term outlook on the market. It's either going to go up or it's going to go down. But remember, I told you that there'd probably be a rally from the end of quantitative tightening. And some people are starting to talk about that. So there are some reasons why we might get a rally. Stock market, monthly chart. Look at that. Looks like it's probably bottomed out. Here too. So when you flip it to the weekly though, kind of in the middle. Middle to bottom. Same thing here. Could this fall off a cliff? With bad news, it could. Maybe with an Iran attack, it would fall off. But then it probably bounces back. Why? Because the longer term charts look like they've really drifted to pretty significant bottoms. With money not being taken out of the economy and with interest rates going down a little bit, right? The $50 billion a month from the quantitative tightening, that's not happening anymore. That's $600 billion a year not getting sucked out of the economy and the markets. So for the next quarter or two, I'm not terribly scared. However, that doesn't mean that we can't have a horrible week because of some event. Next year is what I'm most worried about. A lot of things start to come to a head about the middle of February and forward. Between now and the early February, I don't feel too scared. I'm not getting too aggressive. I'm not really adding much other than a stock here or there or a teeny tiny ETF position. But I don't want to go crazy and get 80% invested again. I'm happy being 30 to 60% in the stock market, depending on if I'm an aggressive account or a conservative account. Conservative accounts, 30% in the stock market to offset inflation. Aggressive accounts, 60% in the stock market if you want to take a couple extra shots. Howard Marks is out there saying that we shouldn't be cutting interest rates at all because it seems like it's just being done to support the market. I don't know about that. I think that there's plenty of trade-related issues around the world, not just us and China, but Europe and Japan and Korea. There's plenty of trade-related issues, and it's a transition. And in transitions, things get bumpy because there's unknowns. So I don't like the way next year is shaping up, especially if it looks like President Trump is going to lose. Then people who are worried about their tax breaks going away, they're going to be net sellers. Oh, and by the way, the baby boomers get another year older, another year of required minimum distributions, and pensions, which hold a lot of the money, remain in net distribution. And pensions will be in net distribution forever. So until we get QE again, or we get some incredible technological thing that makes standard of living go up again, or helicopter money, which is where I think it's headed, don't expect giant rallies in the stock market anymore. That doesn't mean we can't get a short-term rally that spikes it up high, but when the bend in that curve gets silly looking, almost vertical, you'll need to be a seller. So we're still, and will remain, in a sell the rips environment until they do stimulus, one way or another. All right, I'm going to let you go. I'm going to turn off the recording, but I will go through and try to answer some more questions.